oil prices have been cooling off, falling to the lowest levels in over a year. Brent, for instance, has been trading below that $100 mark, has lost about 10% this year. Mark Keenan from Societe Generale now joins us on this conversation. Mark, many thanks for joining in. What's your outlook on oil prices right now? Brent is something that we track very closely here in India. It's trading below 100. What's working on the mind of the market?
Yes, good morning. Thank you for having me. Brent has shifted down recently into what we see as a new trading range for the rest of the year, possibly centered around $102.50 a barrel. As you point out, it's below $100 at the moment. In our view, that's perhaps a little bit overdone. And we can expect prices to move slightly higher above this very important psychological $100 level. In short, the market at the moment is really being driven by a hugely diverse set of factors that are collectively blending together to give rather a muted impact on prices, insofar as prices tend to be pretty range-bound, pretty uninteresting considering what we've seen over recent months. The most obvious thing really to sort of start looking at or to go back and redress is the geopolitical risk premium that we've seen coming onto the oil markets in June, largely as a function of what's been happening in Iraq. And for the first time in quite some time, geopolitical risk has actually affected the back end of the forward curve much more than the front end of the curve. We saw an initial response of Brent up to $115 a barrel and then a reasonably quick retracement down to roughly the levels we are now. Whereas at the back end of the curve, we've seen a $8 to $10 increase in prices, and prices have stayed there. And one of the interesting things, especially with long-term forecasts and what this means, is that the reason why this has happened is that the market was very much expecting extra supply on the market from countries like Iraq.
Sure.
Prior to the ISIS tensions, people were looking at Iraq increasing their output up to around 6.5, 7, 8 million barrels a day up towards 2020.
Sure.
This is unlikely to happen now, or been severely delayed at the very least. And so people have viewed, this as quite bullish for the back end. Also, with respect to Russia, the conflict there hasn't affected any output as yet in the short term, but the sanctions on oil drilling machinery, stuff that Russia needs to explore for its own shale and offshore deep water wells, come from the US, and these are not available.
Right.
So that has also increased a little bit of the premium to the back.
Sure, Mark.
But back to prices.
Just one point. One point, Mark. You spoke about the geopolitical tensions. They've really not resulted in a runaway rally in oil prices. Has that largely been because the supply situation has been fairly okay and supply has not been disrupted as many would have anticipated? And secondly, is this risk premium now ending?
Yes, I think it has. I think that initially it was a natural knee-jerk reaction to this occurring in a country that is a substantial oil exporter. This is Iraq I'm speaking. But no output has been affected. Oil is exported from Basra, the south of Iraq, and that is just fine. Much of the disruption in the north of Iraq had already been affected prior to the ISIS advance down towards Baghdad, with the Sunni Shiite tensions destroying the Cheyenne pipeline. So it's all fine with respect to immediate output, and so the geopolitical risk premium has come off. What has added to the weakness in prices is we're moving into a seasonally weak period. The next 2 months, there is a decline in refinery runs, which is the rate at which crude oil is put into refineries to generate the products, the gasoline, the heating oil, the distillates, because you're in between the two seasons. So it's a good time for the maintenance to occur. So that tends to cause inventories to increase and weigh on prices further. One interesting thing also that's exacerbating the weakness is that the front end of the Brent curve has switched into contango, so near-term prices are now at a discount to further dated prices. This extends for about 6 months down the curve. This was not the case at the beginning of the year. So what we're seeing is traders are now they can buy effectively cargoes of Brent-related crude put them in storage, having sold ahead in the futures market and lock in a profit and just simply deliver that crude against that contract. And even recently, I think as recently as yesterday, reports of Chinese oil trading companies have now chartered ultra-large crude carriers to anchor off here in Singapore, off the coast, 3.2 million barrels of storage. These ships are huge. There's the length of the Empire State Building. Just putting crude into storage with this view of selling it again forward. And this is bearish for immediate prices. So that's weighing on the complex as well. To the bullish side, we have distillate stocks that are very tight in Europe, in Japan.
Right.
Distillates are the largest component of the oil barrel, so that will tend to support refining margins. That will tend to support demand for crude.
Sure.
You've also got Saudi Arabia that will likely cut production in this context. So you're stuck within this little range. We're very much at the bottom of the range. But there are supportive factors on the downside and these bearish factors that we've talked about on the upside as well, locking it within this very narrow range that we see developing for the rest of the year.
Sure. I have one final question, Mark, and I'm running out of time. Very quickly, where do you see gold prices behaving? I mean, do you see weakness continuing in gold?
Yes. Gold is again, it's moving into a seasonally demand period with the Indian demand period, the peak demand period approaching. That's not possibly enough to support prices. Gold is generally heading lower, guided by the monetary policy outlook from the U.S. with rising rates, rising dollar being very bearish for gold. And in addition, the lackluster physical buying in China, which year on year is down substantially, as with the case in India. And also, of course, in India, the ongoing restrictions, both on the duties and the re-export quota, still remaining in place. I understand that is under review and will likely be addressed towards the end of this year, but which is in a way a little bit of a bearish factor because people aren't going to do anything until these restrictions are possibly lifted or until there's clarity on them. So gold lower. Down to 1,200 roughly. We see 1,245 being the average price in gold in Q4 of this year.